Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, let's get started. So, Currency Week. I have to admit, of all of the lectures in this course, this is the only week where coming into the lecture, I feel that little bit of nervousness, thinking, oh my God, I hope I'm on the ball. Because the thing about currency is that you always need to be really clear in your mind and in what you write in the exam or what I say in class about the direction that you're talking about. I mean, if you start with the basic fact that Australia is an indirect quotation system, whereas a lot of other countries, including the US, is a direct quotation system. Right? In Australia, because we're indirect, when you look at an exchange rate, is it $1 Australian is worth X of the foreign currency, or one foreign currency is worth X Australian dollars? Like, the Aussie dollar exchange rate today is what, 71? 0.71 with the US. What does an exchange rate between Australia and the US mean when I say 0.71 for an indirect system? $1 Australian is worth 0.71 US cents. So that's the first thing. If any of you have spent any time in countries that use the direct system, remember, here we are indirect. Whatever number you see is the number of foreign currency that a single Australian dollar can buy. Now, I'm sometimes told that other courses do use the direct system, and I understand that that might be confusing if you move between them. We use the indirect system because that's exactly what's used in Australia. You turn on the news, that's what's quoted. You look at any kind of, Google Finance or anything. If it's an Australian site, it's going to be quoting the indirect quotation. And all of the articles do as well. So that's why we focus on indirect. But keep in mind that if you're ever in a country with direct, that will be flipped. So that's the first thing you need to be careful of. The second is whether going up or down is good or bad. We are Australian investors. We have put our money in a US investment, right? So we've already got overseas investments. At a certain point, we're going to realise those investments and convert them back to Australian dollars. So we have overseas investments. To us, is an appreciation of the Australian dollar good or bad for our returns? Bad. So that's the second thing. The Aussie dollar goes up, that's bad for our returns. Because when we convert back into Australian dollars, a higher Australian dollar means we need to waste more of the overseas currency to get just $1 Australian when we convert it back. Whereas when the Aussie dollar goes down, that is good for our overseas investments because a low Aussie dollar means that the Aussie dollar is cheap. So we're going to get our 1 million US and convert to heaps more Australian dollars because the Australian dollar isn't worth much. Now, I don't know about any of you, but I do a lot of overseas shopping. So for me, I need to flip my perspective in that because I love it when the Aussie dollar's high. It makes my overseas shopping cheaper. But in investments, we want the Aussie dollar to be low. Same with a lot of our outputs, like, our farming, etc. A low Australian dollar makes Australian products cheaper. So there's another flip. I'm going to go through all of these as we go through. Here's another one that you're probably not used to. Forget about currency for the moment. If you think about what you learn in Foundations of Finance, what you learn in derivatives, does hedging in a normal world add to risk or get rid of it? Get rid of it, right? You have a risk, so you hedge it away. What we're going to see today is that in Australia, because of the correlation of our dollar with overseas markets, when we're deciding whether or not to hedge our currency risk, hedging is the higher risk option compared to not hedging when you look at the volatility of global returns. Right? And the reason is that when overseas markets are down, the Aussie dollar tends to be down too. So if you're not hedged, yes, you've got a bad return in your overseas market, but because the Aussie dollar's down, that actually gives you a bit of a kick up when you convert back to Australian dollars. But if you've hedged the currency movement away, you don't get to benefit from the depreciation in the Aussie dollar. So what we're going to find today is that being currency hedged actually adds to risk and return because of something called the forward rate bias, whereas not hedging your currency risk is the lower risk return option. So again, it's flipping from what conventional theories taught you before. And all of this is important because up until now, you've been dealing with two asset classes, world equities unhedged and world equities hedged. And we haven't really emphasised how important that choice is. To illustrate how important it actually is, can someone tell me what is Abigail's tracking error constraint? What's her maximum tracking error? 1.5%. I love that you all know that off the top of your heads. You should, but it means that you're well into the assignment. 1.5%. I'm going to show you an example using real data. And in this example, the peer group has a quarter of their portfolio in overseas equities. You guys, imagine, also have a quarter of your portfolio in overseas equities. All of your weights are exactly the same as the peer groups. All of your investments are exactly the same as the peer groups. So everything I'm saying right now is telling you zero tracking error because it's identical. One difference. The 25% weight in global equities of your peer groups is half hedged, half not. Right? So they have 12.5% hedged, 12.5% not hedged. You guys are fully hedged in that 25%. So you both have a 25% weight in global equities. Half of that is currency hedged for your peer group. Either all of it's hedged for you or none, it doesn't matter. That one decision is your 1.5% tracking error. Right? One decision. Everything else is the same. So in that case, had you decided to fully hedge or not hedge when your peer group was 50% hedged, with a 1.5% tracking error constraint, you could not change your asset allocation in any way once you've made that decision because you'll violate your tracking error. So it shows you how much that decision matters to risk. To show you how much it matters to return, if you look at the historical return of unhedged versus hedged world equities over a year, the difference in return has been as much as 30% per annum in either direction. Right? This is the same asset class. All that's different is hedging your currency risk or not, because currencies are volatile. Okay, so it's kind of scary how much this decision is going to matter. So that's essentially going to be the focus of today. We're going to start by saying, look, what is global investing? Why is it more difficult in many ways than staying in Australia? And that links into the fact that we can start to understand why in Australia and all around the world there is a home bias in portfolios. Once we understand the setup of global investing, we then spend about 2/3 of today looking at that decision of whether or not to hedge the currency risk. Now, two things to note. One is that it is quite technical at first, but we're not actually introducing that many different concepts today. Right? It's all focused, once we move into currency, on do you hedge, do you not? How do you figure out how much to hedge? We look at the return and the risk of that decision, but it's just one focus. It's not like other things other weeks where we're looking at a number of different things at once. But it is quite technical. So in my experience, it's often the week that, particularly straight after the lecture, students go, oh my God, my head, I don't want to think about this anymore. And I was the same, to be honest, when I first started looking at this. But once it clicks in your mind, you've got it, right? You'll understand it. And then it's just a case of knowing how to apply it in concept and in math. But you've got your principles. So just write little examples like I'm going to teach you today. And if you ever get uncertain, you can sketch enough basic examples that you'll figure out your direction again. The last thing I wanted to say is that it's possible that you won't get a numerical question on this week, but it's very unlikely. I have never written a final exam that hasn't included a numerical question based on global investing and currency hedging. It's one of the few numerical parts of the course that you can do by hand, and I need some numbers. It is finance after all. So when it comes to your exam prep, let's assume that you will have at least one numerical question on the currency hedging decision. Maybe calculating the hedge ratio, maybe calculating the forward rate because of covered interest parity, maybe both. But focus on the numbers this week. Don't write it off as too hard, because it will probably appear in your exam. All right, so as I said, today we're going to look at what's different when you look global as opposed to just in Australia, and how important the currency hedging decision really is. Before we go into the specifics, just to really link what we're talking about to the data, you've actually been implicitly making this decision all the way through the course. Because if you have a look at world equities in particular, at equities in particular, what you have in your assignment and in most of your tubes is data for Australian equities, data for world equities where you don't hedge your currency risk. This data is actually well-developed markets where you don't hedge your currency risk. Then data for world equities where you do hedge your currency risk, and an emerging markets class as well. What we're going to be focusing on today is how to split your money between these two asset classes. We're also going to talk a little bit about how different asset classes are seen in the industry, because, for example, fixed income and Australian and world fixed income is separated into Australia and world ex-Australia, but there's no hedged and unhedged part of world fixed income. Can anyone remember, in world fixed income, do you typically hedge or not hedge your currency risk? Not hedge. You typically hedge your currency risk. Yeah. We haven't really focused on it in the course, but now you're starting to actually attach why the data is the way it is. So in fixed income, the standard practice is to hedge. That's what this world fixed income category is. There is no unhedged fixed income. The hedging decision happens in equities. Then you're going to have asset classes like hedge funds and private equity, where we don't separate out Australia versus world at all. The reason for that is that in both of those asset classes, there isn't a lot happening in Australia. There's some hedge funds in Australia, there's some private equity funds in Australia, but it's a small market and it doesn't really make sense to allocate your money to Australian hedge funds versus world hedge funds, right? You just view it as an overall category. So we're going to talk a bit about that too. Now, if you have any questions, ask me. If at any point you feel like I've said the wrong thing, like, you know how when you're in a car and you're giving directions and you say turn left, but you mean turn right? I can't afford to do that today. So if you ever think that I have and get confused, just ask me and I will think about what I just said and clarify if I'm wrong. But it's fine, I'll get it right. God, I've done it enough, so you'd hope I'd get it right. But it is one of those things that you always need to be careful of direction. Okay, this first part, though, is less technical. It's more just conceptually. We talk about global investment, but we don't really, until now, talk about why you'd invest globally and how much you should and whether a home bias is justified or not. So that's where I want to start today. And the first thing I want to say is probably all of you could walk out of Foundations of Finance, and even though you didn't spend time on global versus local investment, at the end of that course, had I said, why would you invest globally? You could probably answer just off the top of your head, because it's right back to the very base of finance theory. When you invest globally instead of just locally, it gives you benefits with diversification, with a broader opportunity set, and is consistent with modern portfolio theory. Now let's start with diversification. Why would investing globally rather than just in Australia give you diversification?
You can diversify some country-specific systems.
Yep, so one of the first things is different countries' equity markets are not perfectly positively correlated with one another. Right, so even if you're just investing passively in overall indices in the US, the UK, Australia, frontier emerging markets, normal emerging markets, they're not perfectly positively correlated. The second you add additional assets with less than perfect positive correlation, you can diversify and therefore improve your return per unit of risk. The second one is a broader opportunity set, and that's particularly important given that we're in Australia. Why would looking globally, let's think about equities right now. Let's say previously we were only investing in Australian equities. We're now going to look overseas. Why would doing that broaden our opportunity set, particularly given that we're in Australia, because our equity market's quite unique?
Because Australian equity market is smaller than US.
It's smaller, That's one. So you've got a lot more stocks to choose from, more stocks and more opportunities to get alpha. And what's the other thing? Think about the Australian equity market in terms of the industries. What's the other thing?
Mining.
Yeah, heavily biased towards mining, resources, and banks. So if you want to get a good tech exposure, if you want a diversified consumer stock exposure, you're not really going to get it here. But the second you look overseas, you want a tech exposure, you've got Google, you've got Apple, you've got IBM. You want consumers, you've got Nike, you've got Macy's. All of these household brands that you know, you probably talk about every day, you probably use the products, but they don't sit within the Australian market. Okay, so going global broadens your opportunity set and lets you access industries that you wouldn't get a big exposure to here. And the second you have more stocks, you have more mispricing opportunities if you're active. And the third is modern portfolio theory. It says the market portfolio is optimal. What is in the market portfolio? Everything, exactly. All available things that you can exist in the proportions that they exist. So that's not specific to Australia, it's worldwide. And I'm going to show you a statistic when I move into this box in a moment. But to think about it in the context of modern portfolio theory, the Australian equity market is less than 3% of the global equity market. Now, if you're going to invest in the market portfolio, well, Australia really technically should only be about 3% of that portfolio. So you have to look global. So traditional finance theory seems like it's completely obvious that you should not just diversify overseas, but actually have most of your portfolio overseas. The reality is different. People do invest overseas, but in far smaller proportions than what modern portfolio theory would have you believe. Now, I'm going to talk about the reasons why in a moment, because I actually think that to completely correct the home bias would be a mistake. There are benefits to investing in Australia that you don't get overseas. But I do think the home bias is more severe than it should be, even now. So we'll talk about why that occurs in a moment. But before we do, let me give you guys some context. This, first of all, is back in 2008. It was the last time a direct comparison for this specific institutional bucket was drawn. But I'm going to give you an updated series of a different categorisation of institutional funds in the next slide that goes up to today. But first of all, back in 2008, you could see Australia, as I said, was only, well, less than 3% of the global equity market. That is still true today. Institutional superannuation funds, though, had over half of their assets allocated in Australia. That's a massive home bias, because without a home bias, you'd have 3%. They have over half. On top of that, these are the professionals that invest for a living. So if anyone should know about the home bias and correct it to the point that they see as optimal, you'd think it would be the institutions. So it shouldn't be a surprise that when you look at all superannuation funds, which include retail investors and SMERFs, the home bias is even more severe. Over 3/4 of assets in 2008 were invested in Australia. Now remember, that's all super funds, including the institutions that only have half of their weight in Australia, which means that there's a whole lot of retail super investors and SMERFs that essentially have everything, or almost everything, in the Australian market. So I don't even want to think how old you guys were in 2008. It was younger than I am, but you're probably thinking, who cares what happened back then? Probably a lot's changed. I'm using a different data source, so the numbers aren't directly comparable. Unfortunately, that study hasn't been updated. But this is a consistent data source of the home bias from 1998 through to 2017, but that's an expected figure because this is from one of the readings that you did in week 1. At that point, we haven't got a full 2017 reading yet out from the Towers-Watson studies. But this is the most recently available data. And what you can see is, first of all, the home bias, it's worldwide, and it's reflected in the fact that every country in the P7 has a home bias. The second thing you can see is, yes, it's dropping, but not by very much. And if you have a look at Australia in 2008 compared to today, it's barely different. This is the institutional side. So you can still see that institutions are putting roughly half, a little bit more of their assets in Australia. Now, if you go onto the ABS website, you could see the same figure for retail funds, and it basically hasn't changed. In fact, I'm kicking myself now. I should have actually added it to this slide. But it basically hasn't changed from this amount here. It's still about a quarter in terms of the overall superannuation fund industry. So yes, there was a home bias 10 years ago. There is still a home bias. It's coming down ever so slightly, but really not very much. The next thing to see is that the home bias in Australia is high, even when you don't think about how small our equity market is, right? Out of all of the P7 countries, we have the second highest home bias. And that's before you consider that we're only 3% of the equity market, which makes it more severe. So Australians really do love all things Australian. They are investing a lot in their own country and not a lot elsewhere. By the way, just because it occurred to me, I just wanted to call your attention to a post I put up. I had, I think, 2 groups ask me this, and I'm really glad, in case anyone else is confused. I have a line for Robert that says, he maintains a fondness for all things Australian and requests that at least 60% of his portfolio stay in illiquid Australian assets. It never occurred to me that what I'd written could be read a different way. He has a fondness for all things Australian. I mean that as an expression. He loves Australian things in general. I don't mean all asset classes. I mean everything Australian. He's one of those guys that has the Australian-made, Australian-owned stickers on his ute, or fancy car, because he's probably not a ute guy. Okay, so what I'm saying is he loves Australian things, and as a result, his only constraint about Australian assets is at least 60% of his portfolio is in liquid Australian assets. That does not mean that his whole portfolio needs to be invested in Australia. Only 60% out of those liquid asset classes. Does that make sense? So please, no one freak out if they're trying to put everything in Australia and can't meet the objectives and constraints. You don't need to. It's one of those things, unfortunately, with assignments, you sometimes miss the way that other people will interpret your words. So I'm glad that was raised. Okay, so Australia, big home bias. With our sort of theoretical finance hats on, it seems ridiculous. But remember, in this course, it's always about moving it into the real world and questioning the finance theory. And the second we do that, we realise there are a lot of reasons for investing in Australia. There are a lot of reasons for having an Australian equity weight above 3%. That doesn't mean it should be 3/4. Right? Even with your reality hat on, that seems rather high as an average for super funds. But I do think it's fair enough that it's more than 3%. There's a lot of reasons for that. The first is familiarity. Right? Remember how I said, this is particularly true in Australia. I just referred to that Australian-made, Australian-owned thing. If you don't know what I'm talking about, I'm sure you will have seen the sticker. This is such a popular thing to see around in Australia. It's on products, people put it on their cars. Aussie pride is real, right? We love, as a culture, to invest in anything Australian. So in Australia, it sort of makes sense, you know, you're going to have your Aussie barbecue, you're going to buy your Aussie products, and you're going to invest in Aussie stocks. It is ingrained within our culture to support things that we make ourselves. So culturally, people would have an ease and a familiarity with Australian products. They like walking down the street and seeing the companies that they invest in. And related to that is monitoring, right? If you want to actually be an investor that goes to the annual general meeting of the companies you invest in, that monitors the actions of shareholders, it's a lot easier to do that if you're investing in Australia versus overseas, right? If you had a global portfolio and wanted to go to all the annual general meetings, you'd be on a plane 3/4 of your life, So, because of that, not only are you familiar with Australian stocks, you can monitor them a little bit easier. Now, the issue with monitoring is getting less because as technology improves, the world gets smaller, right? It's easier, you've got web conferencing, you've got high-speed flights, but people do have a preference for keeping things close to home. The third is tradition. Remember how we said from week one the industry moves slowly? Historically, the home bias has been large in Australia, as it has around the world. Yes, you can argue it is slowly being corrected over time, but it's never going to suddenly jump to disappear. I'll come back to fill the buckets, but another reason why it isn't suddenly going to disappear comes down to peer risk and regret. We looked at this in week 2 or 1, I think 2, where we said that historically Australian equities have outperformed overseas equities. And we know that the typical Aussie multi-asset class portfolio has a large weight in Australian equities, right? They have a large home bias. So if you wanted to lead the way in correcting the home bias while your peers stayed with a large proportion in Australia, if Australia continues to outperform, 1, you're going to get a big tracking error, and 2, you're going to seriously regret your choice because you're now underperforming your peer group, dropping down the league tables, and you might lose assets under management as a result. Okay, so because traditionally people have a big home bias, trying to correct that will bring on tracking error risk, and it might make you regret your decision. If we go back to fill the buckets approach, let me get a pen. This is one that I do think actually has is a big driving force behind the home bias for pure operational reasons. Remember, with the fill the buckets approach, you have a super fund. Thank you. Oh, yeah, don't want that. Okay. You've got a superannuation fund. Oh, stop it. There we go. With a pot of money, this might do it every... No, we're good? Okay. With a pot of money. And then remember, you decide how much of that money to put within equities, fixed income and alternatives. Within your equities, how much do you put in Australian equities? How much do you put in world equities? Unhedged and hedged. How much do you put in emerging markets? And so on. And you decide how to allocate your money by taking each bucket and splitting it up further. Now, for big superannuation portfolios, what tends to happen is they have an in-house investment team that manages some of the assets, and then they outsource the rest to external managers. UniSuper is a good example. Now, when you have an in-house team, what they usually focus on is active investment in Australian equities. In other words, your in-house team will be managing this money here. You will outsource the rest to external managers. It's really expensive to actually create an in-house team, right? You have a bunch of employees, you need to pay their salaries. You want good employees, which can't be good managers, which isn't cheap. Now, there's no way you're going to go to the time, effort and cost of setting up an internal investment team and then giving them 3% of the equity weight of the overall portfolio, which might be 1.5% of the dollars you have to manage. It doesn't make sense. It wouldn't be cost efficient. So what you want to do is you want to give them enough money to invest to make it worth their while, to make it sensible, right? Otherwise, outsource Australian equities as well. So a lot of super funds that do have an in-house team, it naturally lends to having a home bias. That doesn't make it a bad thing if they have a skilled team that's good at picking Australian stocks, though. Particularly since Australian equities is one of those areas where you can outperform, and in fact the average Aussie small cap manager does outperform. So again, it's not necessarily a bad thing, but it's consistent with the way the industry is set up. And the last one's franking credits. What is our tax system in Australia? Classical or dividend imputation? Dividend imputation. If you were a UK investor, so you're an English investor investing in an Australian stock, could the English investor access the franking credits paid as part of the dividends? No. Can the Australian investor? Yes. We're in a dividend imputation system, and Australian investors alone get access to that franking credit. And if you think back to our equity week, that franking credit can give a big boost to your return. So that's a big additional return that Australian investors can get from investing in Australian stocks that foreign investors can't get from investing in our equity market, and that we can't get from investing in overseas equity markets, even if they do have dividend imputation systems. Right? Canada and the UK have dividend imputation systems, but we're foreign investors in those countries, so we don't get the franking credits. So that's an additional return boost that Australian investors get from staying invested in Australia that does alter the risk-return attractiveness of our asset classes or our equities relative to the rest of the world. So a lot of these reasons means it makes sense to have more than a 3% weight in Australian equities. So I don't want you guys to walk away thinking that you should only be recommending 3% for Abigail or Robert. The constraints mean that you can't anyway, which is lucky. But I don't want you to think that that's what I'm implying. What I am saying is that 3/4 of the weight does seem a little severe. So expect it to continue to drop, but it will be interesting to see whether at a certain point it starts to level out more than it has done, and that will start to get an idea of what the actual optimal level is in reality of Australia versus the rest of the world. Any questions on that? There's one other reason that does reinforce the tendency to want to stay local, and that is it's just harder to go global. Right? If you guys have spent the last 10 years investing in Australian equities, you know your stocks, you know the Australian equity market rules and regulations, you're comfortable doing what you're doing. And I suddenly say, all right, our fund's moving global, start investing overseas. You're going to think, God, that's a lot of work. Because I need to understand the different countries, their regulatory systems, their accounting systems. They might not follow international financial reporting standards. I need to figure out the cultural differences that might mean that certain investments are harder when you're not doing it face-to-face. I mean, I have friends, for example, that work in Indonesia, and they say you could not do it from here. You have to be there. Because you find out information when you're face-to-face and form and nurture relationships that you will not get if you're trying to do it from outside. You need to understand new industries because you haven't bothered really getting a good grip of tech stocks when there isn't a lot of tech in the Australian equity market. You need to conquer new worlds, and that's going to feel a lot harder than sitting in the Australian market that you know and that you have a history with. You need to decide, do I hedge my currency risk? Or do I outsource it to a manager to hedge it for me, which luckily isn't going to be too expensive. We'll talk about that later. It's about 5 to 10 basis points a year, but it's another decision you have to make. You've got, as I said, more securities and more countries to analyse. Or even if you're a multi-asset class investor, if you're not going to invest overseas directly, you're going to outsource it to a manager, which means you're going to have more managers that you need to monitor. And you also need to decide, how am I going to view the world? Am I going to view the world as one global asset set? Am I going to view it as Australia and the world excluding Australia? Am I going to split the world into different countries? Am I going to keep all countries together but split it along different industries? There's no one right way to do it, but how you choose to separate your investment set will affect your ultimate portfolio in reality. Okay, so there's a lot more decisions to make. There are information gaps. I said before the world is getting smaller, luckily. So in other words, technology, for example, means that you can access other countries quicker, you can have video calls, you can fly to the other side of the world in a day. But you've still got different countries. You need to understand their different regulatory standards, their different disclosure practices, their different levels of transparency. Even if you do want to access and meet managers or go to meetings face-to-face, you're going to lose time. You might lose a day on either side getting to and from the other side of the world. So, all right, the information gaps are getting smaller, but they still exist, which make it harder to invest overseas. Access is often more limited, so a lot of overseas managers don't even bother distributing to Australia. I mean, we're 3% of the global equity market, so we're 3% of the potential customers. A lot of managers just don't see it worth their while to set up a distribution channel here. There's higher costs. Are you going to hedge your currency? If you are, the very act of hedging is going to have costs for things like rolling over contracts. If you outsource it to an overlay currency manager, which we look at later, that's going to have management fees. There's higher transaction costs, particularly in things like emerging markets that are less liquid. In things like emerging market funds, if you outsource to an external manager, they will usually charge higher fees than an Australian manager. You have tax differences, right? Is it a classical or a dividend imputation system? There might be withholding taxes, and if you don't have a tax treaty with Australia, you're not going to get it back. And then there's the operational differences, right? I mean, we're so far away from the rest of the world. If you want to invest on overseas exchanges, you're not going to do that within Australian business hours because they don't overlap, or there's only a very small window in which they overlap. You might need a custodian to manage your assets for you. There are different local rules. So all of these, I'm going through all of these just to sort of make you aware that it's not as simple as saying, of course you should invest overseas. You should, but it's harder. And as a result, it adds to the tendency to stay local. Now, I didn't want to finish that with a negative, given that I'm encouraging your asset allocation to include overseas assets. I want to finish this by saying most of the challenges that I've spoken about actually disappear if you want to go passive, not active. And that might be something to keep in mind when it comes to your assignment as well. If you go passive, maybe not the currency hedging decision, but almost everything else you see here doesn't matter so much because you're not trying to find mispricing. And on top of that, you can actually invest in passive options, still investing on the ASX. So for example, BlackRock has a series of iShares where you can actually purchase an overseas passive investment in equities just by trading on the ASX on your CommSec, right? So it's really easy to get a passive exposure overseas, which makes a lot of those challenges go away. So ask yourself, and by the way, the downside, what's the downside of a passive investment? Sorry? You lose your alpha, right? So if you might want to say, look, I think the challenges of overseas investing outweigh the potential benefits, and I'm going to argue that and therefore recommend a passive exposure for my world equities for Abigail and for Robert. Or you might say, well, I want to keep my alpha because I think that there are certain areas where global managers will outperform. You might do a bit of research to that effect. Or you might say, well, in emerging markets, there's still scope for alpha, maybe active in emerging markets, but for my global exposure, I might go passive. It's up to you. You pick what you want to argue based on what you think is right for the client. I don't mind, by the way. I could give an active and a passive argument equally high marks as long as they're argued well, because there is no right answer. But it's the type of thing that you might want to think about, and you might want to back up your argument with a bit of research. These are all just ideas, but there's really no limit to how far you might want to take it if you're interested and you want to bring it into your assignment. So remember how I said at the start, though, that you really need to decide how you're going to view your opportunity set if you're going to invest overseas. Now, there's a broad range of ways that people do it. And just sorry, to give you that context again, what I'm talking about here, equities, do I go Australian equities, world equities, unhedged, hedged, emerging markets? Fixed income, Australian and world fixed income, that's what we call separating the two, right? You've got Australia and the rest of the world excluding Australia. Or do you view it as a global opportunity set, like you do with hedge funds and private equity? Not Australian hedge funds and world hedge funds excluding Australia, just hedge funds. Or Do you separate them and only focus local? There are some asset classes where you might not want to go global. Can anyone think of an example that we've given in the past few weeks where I said there is an advantage to staying within your home country? Direct property. And what particular type of direct property? Yeah, unlisted direct property. But so with unlisted property, sorry, I've got it in my head. Which is about, so with unlisted property, what are the different types of unlisted property you could have? Core and non-core, which is value-added or opportunistic. And remember we said that non-core direct property in particular, there's an advantage to staying local because essentially you need to drive the economic value add yourself. And so you need to be on-site, you need to be present. It's a lot easier to do that when all of your investments are within Australia than if you're flying around the world. So one of the things that's going to matter, therefore, is the investor. It will depend on what your investment strategy is and what your objectives and constraints are. But what I have on the left is just sort of what the general tendency is in the industry. There's always going to be people approaching it from different angles, but I've essentially just said, well, for each asset class, what tends to be the majority of what approach do the majority tend to follow? Now, in equities, there's a tendency to separate Australia and world ex-Australia. You might split out emerging markets too, which is what we've done for this course. And within the world developed markets, you'll decide, do I hedge or not hedge my currency risk, or do I have a mix of both? And typically in the industry, you'll see both hedged and unhedged world equity exposure combined into the same portfolio. Not necessarily 50-50, but a mix of the two. In listed property, it is mixed, but there's a move towards taking a global view. This is listed property, because there is more and more listed REITs that are global, and the Australian listed property market is really concentrated. About half of it is Westfield, and about 3/4 of it is 5 or 6 names. Right? So you're not going to get good exposure by focusing just on Australia. So rather than separate them out, people are tending to look a bit more global now with listed property. Fixed income, people did typically separate it, and that's what we have in our assignment and in the course. We've got Australian fixed income and world fixed income. But there is a move towards taking a global view, and when I say global view, I mean the one manager having both Australian and overseas fixed income assets. And that's the rising Core Plus mandates. Right? Remember, Core Plus, most of your portfolio is managed to track a benchmark in Australia, but there's a small proportion that can be invested overseas. In fact, it can be invested anywhere outside the benchmark, but these managers tend to go overseas because that's where they get their corporate credit exposure. There's not a lot of higher risk corporate credit in Australia, so they go overseas, take on a small proportion of higher risk corporate credit, and it boosts up their returns. We did that in week 7. Inflation-linked securities, there is a mix, but remember, it comes back to your objectives. And if you're investing in inflation-linked bonds because you're worried about the effects of Australian inflation, then this is one of those asset classes where it makes sense to actually separate it and just focus on local, right, rather than looking at global as well, world excluding Australia as well. So in ILBs, and that's actually what you have in your assignment, you don't have Australian ILBs and world ILBs, you just have Australian inflation-linked bonds. Direct property and infrastructure, you tend to stay local, particularly when it's non-core. It's a lot easier to monitor when it's local, and these are real assets, so they give you a local inflation hedge. Hedge funds and private equity, as I said before, there tends to be a global view because there isn't a lot of either asset class based in Australia, so it makes sense to view it together. Now, in general, in the future, if you're going to allocate assets, there's no one right way to view it, but there is some principles that it is important to follow, even if you do separate Australia from the rest of the world. The first is that everything needs to come down to your objectives. Okay, so look at the risk-return trade-offs, but always in the context of what you want to achieve. Just because someone else is better with a higher global weight doesn't mean that you are. Right? If you're a defined benefit fund and all of your liabilities are based in Australia and they're pegged to Australian inflation and discounted using an Australian discount rate, then it might make sense to have a large weight of your assets in Australia and probably tending towards fixed income. So it just depends on who you are as an investor. But wherever possible, think about your portfolio in a global sense, even if you're going to manage the Australian and the overseas portions separately, right? So just check that you combine your Australian and overseas asset classes, look at their holdings together, and check that you have good diversification. Check that you have a spread across industries. Check that you don't have any unintended country exposures that you might miss if you just look at one separate from the other. You can choose to separate your currency and your asset investment decisions. We're going to look at that later today. That's currency overlay management. Remember, if you want to invest overseas and you don't have the expertise, outsourcing to external managers is often an easier option. And if you want to keep the cost low, remember the best way to do that is outsourcing to passive managers. And it's particularly easy to do that with a global ETF because they're often listed on the ASX. Any questions on any of that? So it's, for once, a super early break, but let's take a break now. We'll come back at 5 minutes to 3, just because we're now going to move into currency, and this is the best place to break the two topics. Now, just quickly, in terms of the assignment, every one of the assignment workshop videos, I chose what to say based on either issues that you guys have given me or issues I know that groups have. So I've done them specifically to help you guys. So if you haven't watched even one assignment workshop video, I recommend you do. Watch every one of them, and actually, funnily enough, now that you're starting to come into problems, even if you were sitting in the workshop, it might be a good idea to just go through the video again, even if you go through it on faster speed and pause where you know I discussed it, because I hope, the reason I've structured it that way is that it gives you guys an asset when you're sitting there at home at 1 in the morning and your Excel file isn't working. You can actually follow the process and my description of it to try to figure out where it went wrong. So if you remember, the assignment workshops started in week 7. There's only been 3 of them, so it's only 150 minutes of your life. I'm suggesting that you lose, but I do think it's worth it because I actually created it to help you guys along the way. All right, so currency. We're now getting into the mathematical part of it. If at any point, either now or when you revise, you start to think, oh my goodness, too much is happening at once, stop, go back to first principles, because there's only a few different things that we're looking at here. It's just because it's all numerical, when you first come across it, it can seem more complicated than it is. I promise you, like I said at the start, once you have it in your mind, you're good. It's not that difficult. The calculations are not particularly difficult. The concepts aren't difficult. But we have a number of different things happening at once at first, which takes a bit of getting used to, right? You need to remember the return side and the risk side. You need to remember you're in an indirect quotation system. You need to remember when the currency goes up, your return goes down, providing you're not hedged. Right? So at any point you have questions, please ask. If you want me to repeat myself, please say. As it is, I probably will repeat myself a lot. It's just to try to get the concepts into your head. And I do recommend that if you're ever sitting in an exam getting confused about what, for example, an appreciation would mean for your return, do something like this in the corner of your scribble sheet. I still do it today sometimes when I'm sleep deprived. Right? Just actually get the most basic numbers, an exchange rate of 0.5 and 1, and just trace through what that means for your return, and then you've got it there to quickly refer to as you then go through your exam. So remember, in Australia, you all know that we're in the indirect quotation system, which means $1 Australian will be quoted in terms of the number of foreign currency it can buy. So when the Aussie-US exchange rate was at 0.5, and it did happen back in the early 2000s, it means that 1 Australian dollar will buy 50 US cents. Now with indirect quotes, remember rising exchange rates mean the domestic currency is appreciating. So that's the nice thing about indirect quotes. The number goes up, you know the Aussie dollar's going up. Number goes down, Aussie dollar's going down. Whereas you need to flip that if you're in a world of direct quotes. But where you do need to be careful to flip the direction is moving from movement in currency to movement in returns. Because when the Aussie dollar goes up, our returns on our overseas investments go down unless we've already locked in the exchange rate. If the Aussie dollar goes down, the return on our overseas investment goes up because we can convert the same US dollars, say, into more Australian. So here's your basic example, right? If you have an investment worth $1 million in the US and the Australian-US exchange rate is 0.5, it means that 1 Aussie dollar is only worth 50 US cents. So in other words, 1 US dollar is worth twice as many AUD. So you take your 1 million US dollars, you divide it by 0.5 to see that you get 2 million Australian dollars. Very good for us when it comes to converting our US money back into Aussie dollars. If the exchange rate then moves up to parity, which also happened more recently than 0.5, it was at parity only a few years ago, it means that 1 Australian dollar is worth 1 US. So if you have $1 million US dollars, you convert that into 1 million Australian. So what you can see is when the exchange rate goes up, right, when the Aussie dollar appreciates, the amount we get from our overseas investments goes down. It seems so obvious, but once you start to bring together all the different parts, it's sometimes nice to have that simple example in your mind. Okay, so now that we've got that, we're going to start to get into the idea of, do you hedge, do you not hedge, how much does it matter, and the answer is a lot, and what type of considerations do we need to think about when deciding how important or what the currency hedge ratio should be for us. So this is actually where I started introducing the topic to you today. If we first start by looking at the chart, what you can see here is the annualized returns to world equity when you don't hedge your currency, less the annualized returns to world equity when you do. So anything above 0 means that unhedged world equities outperforms. Anything below 0 means that hedged world equities outperforms. The first thing you can see is that whether you use a 12-month or a 36-month rolling return window, this series is really volatile. If you look at 12-month rolling, this is why I said the decision of whether or not to hedge your currency can mean as much as a 30% return in either direction, right? We've got unhedged outperforming hedged by over 30% in these peaks. Down here, we've got hedged outperforming unhedged by 30%. When you move to 3-year returns annualized, the series is smoothed a bit, but it is still highly volatile. But one of the things that that's showing is that if you have a longer investment horizon, the extremities start to cancel out like you would with a normal equity investment because you have time to ride through cycles. But either way, these are volatile series that we're looking at. And in terms of the two equivalent figures for annual wealth standard deviations, they have standard deviations of 12% per year, calculated in different ways, obviously, because one's a 3-year series. The next thing is they're highly volatile, and the volatility is reflecting movements in the Aussie-US exchange rate. If you have a look, in the early 2000s, unhedged was outperforming hedged. Can anyone think, why would unhedged be outperforming here? What was happening to the Aussie dollar in the early 2000s? It was going down. Again, I don't expect you guys to know that. With every year, I'm more aware that it probably actually was You were younger and younger with each year back in the early 2000s, but it was depreciating. I mean, even I wasn't aware of it back in the early 2000s. I was more focused on riding ponies. I think I was in like year 7, but essentially what we were seeing is the Aussie dollar was depreciating. And remember, Aussie dollar depreciating is good for you because you get to convert your US return into more Australian dollars. So as the Aussie dollar is going down, and it hit about 50 US cents here, as it's going down, we are better off being unhedged, because if we're hedged, we can't take advantage of the depreciation because we've locked in a higher exchange rate. Then what happened is through the 2000s, the exchange rate actually went up. The Aussie dollar was getting stronger through the first half of the 2000s. And what that did is it flipped you to having an advantage to being hedged. Because if you were unhedged, every time the Aussie dollar went up, it was hurting your returns because you were spending more overseas currencies converting into Australian. Whereas if you were hedged, you'd already locked in a lower rate, so it wasn't hurting you in the same way. Then in 2008, the Aussie dollar sharply dropped down back into about the 60-cent range from memory. When it dropped down, it put it back in favour of being unhedged. Massively so if we're looking at yearly returns. And then, as it went towards 2011, the Aussie dollar was strengthening to the point that about mid-2011, it sat at one Aussie dollar got you $1.10 US. It was one of those rare times where it was really, really good spending money overseas because the Aussie dollar was very valuable. And I remember at the end of that year, I was in Nashville, and even then the Aussie dollar was above parity. So I was in the US, where shopping is cheaper already, right after the post-Christmas sales, and the Aussie dollar was above parity, and it was a very happy time for me. Not so good for Australian exporters of goods, but that's another story. Okay, so it really, I mean, this is such a we're only talking about a few years difference, 08 to 2011. Currencies are volatile. So the returns of whether or not you're better off being unhedged or hedged are really changing through time. Then what happened? Well, the Aussie dollar has been dropping, putting you in favour of unhedged until a couple of years ago. Then the Aussie dollar was growing again. This series ends at the end of 2017 because that's where I take all of the return data, because we don't yet have a yearly figure for 2018, and I like to keep it consistent. But let me tell you that what's been happening, in fact, can anyone tell me, over 2018, has the Aussie dollar become, is it strengthening or weakening? It's weakening. So as it weakens, that puts you back towards being in favour of not being hedged. Right? The correlation is there. It's not perfect, but it's strong. There are other things like diversification benefits and the forward rate bias, but we're going to get to those later on. So that's the first thing. It's a volatile series that reflects the volatility in the underlying currencies. This next point is the other thing I said when I asked you what was Abigail's tracking error. This is an example. If the weights are slightly different, obviously, to your assignment, so it doesn't work exactly for Abigail. But the peer group, let's say, has a quarter of their portfolio in world equities. You also have a quarter of your portfolio in world equities. Right, so at this point, you guys have the same weight. So we've got world equities. Your peer group and you. You both have 25% in world equities. So you have the same exposure to global equities in this case. But let's say your peer group is 50% hedged and, God, it's hard to say one number and write another. 50% hedged and 50% unhedged. In other words, that 25% in your peer group is equally split between unhedged and hedged world equities. Let's say you are either 0% hedged or 0% unhedged. 100%. You're either 0% hedged or 100% hedged within your global equities. Right? So you both have 25% weight. Your peer group has a 50% hedge ratio. You have either 0 or 100% hedging. That's going to create what we call a hedging deviation of 12.5% in each case, right? You're either 12.5% more hedged or less hedged than your peer group. It doesn't matter whether we're looking at the first of your lines or the second. With a hedging deviation of 12.5%, when you consider the fact that the standard deviation of the difference between world hedged and unhedged equities is 12%, that is a way of saying that you have an approximate tracking error. It's only approximate, but an approximate tracking error of 1.5% per year. Right? All you're doing is you're taking the standard deviation of the series and reflecting the fact that you're only different compared to your peer group in 12.5% of your asset allocation weight. Right? So just that decision alone would maximise Abigail's tracking error risk if this was her statistics of her peer group versus her portfolio. It's also going to mean that that's potentially the difference between a first and second quartile league table performance or a second and third quartile league table performance. Right? These differences can really affect your rankings, which means that if you take on a very different hedging decision to your peers, if you're right, you'll really outperform. But if you're wrong, you'll lose a lot of money, potentially. So your hedging can have a large impact on your relative risk and your ranking. So the next thing you want to say is, okay, well, we understand that there's a big difference in returns, depending on whether you're hedged or unhedged. How do we actually break down the return drivers of the two asset classes? Because what we need to do is we need to isolate that component of unhedged returns that is different to hedged returns. Because a lot of the things are the same, right? In both cases, you're investing in overseas equities. The difference is that currency exposure, and more specifically, the unexpected currency exposure. So this is in a simple form, but the concepts can take a bit of time to get your head around. So I'm going to take a few slides to go through it. What we've done is we've taken the return to an unhedged world equity investment and split it up into different components. Then we do the same thing for a hedged world equity investment. Forget hedged, let's just focus on unhedged. If you have an unhedged, hold on, sorry. Okay, every so often I really worry about that. If you have an unhedged world equity exposure, you can take the return that you get and split it up into two broad sources. The return from the investment itself and the return from the change in currency. That's what you see in the first line. It's equal to the return on your overseas investment in the currency of your overseas investment. Right? So if you put in $1 million US and you got back 1.1 million US, then your US dollar return is 10%. That is what RI is. This is only expressed in the overseas currency. But if you've made an investment of $1 million in US, then at the beginning you took your Australian dollars and converted it into USD to invest 1 million US. And at the end you're going to take your 1.1 million and convert it back to Australian dollars to realise your total Australian dollar return. So the other part of your return is the movement in currency from when you put the investment in to when you're realising it or when you're taking the calculation. If exchange rates do not move over the period, if it stays flat, what would be the value for delta C? Zero. Right? So this is all about not levels but movements in exchange rates, whether they're going up or down. The next thing to notice is that all of this is in return form. So delta C is not the currency change, it's the return from the currency change. Right? That's written at the bottom. So if the currency appreciates, will delta C be positive or negative? negative. And if the currency depreciates, it will be positive because of that return. Remember, currency movement, the direction is the reverse to the impact on its return. So is everyone happy with that top line? What I want to do now, I'm just assuming you'll call out if you're not, by the way. What I'll do now is break up each of the top two components into its different parts. If we start with just the return on the overseas investment in the overseas currency, RI, this can be split up into the overseas risk-free rate plus the overseas market risk premium. In the bracket, this is the CAPM, assuming a beta of 1, right? We're not going to worry about things like beta here. This is an approximation, but it's to show how we can isolate the different drivers. Okay, so assume a beta of 1, which it would be if it was a passive exposure. The overseas risk-free rate plus the overseas market risk premium gives you the overseas return. The return from the change in currency surprise can be broken up into what we call the interest rate differential, which is the return on the local currency less the return on the international, which is the local risk-free rate less the international risk-free rate, plus what we call the return from this CS term, which is the return from the currency surprise. The currency surprise is the unexpected change in currency, right? So it's saying, I might expect a 10% depreciation over the next year. A currency surprise would be either a greater appreciation or less of an appreciation. In other words, how the currency movements differ from what we expect. That's what this CS term is. Now, it might not be, unless you've done it in investments, it might not be immediately obvious why we have this interest rate differential. It comes from something called covered interest parity. The best way to understand it is an example, as everything is with no arbitrage arguments, because you can create whatever numbers you want and still make this work. Because remember, with arbitrage, if it's zero cost, risk-free in its strategy, what must the profit be? Zero. Right? Arbitrage is having a profit for no cost and no risk. Remember, in efficient markets, there are no arbitrage opportunities because people trade them out of the market. So for no arbitrage to exist, it must be a zero cost, zero risk, zero profit strategy. Here's the strategy. And it's to illustrate, you could use different numbers and you could still figure out the direction. Let's say, and I know these numbers aren't accurate today, but I wanted to make the numbers simple so we can focus on the direction. Let's say that the Australian-US exchange rate is at parity. So 1 Aussie dollar is worth 1 US dollar. Let's say that the Australian risk-free rate is 6% and the US, the overseas risk-free rate, is 3%. Here's a strategy that we're going to follow. We're going to borrow in the US, and we're going to borrow, let's put it in millions, 100 million US dollars today. So today we're going to receive 100 million in US, and that is a 1-year loan. We're then going to convert our US dollars into Australian dollars. Remember, at the moment the exchange rate is parity. So our 100 million US gives us 100 million Australian. We're then going to lend 100 million Australian dollars for a year, right? So we have a 100 million US dollar loan, a 100 million Australian dollar investment. They are both 1 year long. We're borrowing at 3% US. We're lending at 6% Australian. We're also going to enter in a forward contract today that locks in the exchange rate 1 year from now. When we receive when our Aussie dollar loan that we've lent out is repaid, we're then going to convert at a locked-in rate to US dollars to repay our US loan. This is a zero-risk strategy because even though we need to convert in the future, we're going to decide today what that foreign exchange rate is going to be. A year from now, we're going to get 106 Australian dollars. We're going to convert it into a certain amount of US at a rate we'd agreed on at the start, and we're going to repay our US dollar loan. Zero cost, zero risk, and therefore we said zero profit. So what when we get our 106 Australian dollars, how many US dollars must that convert to? 103. If our $106 was converted to 104 US dollars, we'd end up with a dollar profit because we only need to repay 103 US. Everyone would do it, which would adjust the exchange rate. And the same thing if the same thing would happen in reverse, essentially. If we got 102 US dollars, the strategy would be reversed. Everyone would do it, equalising it again. Right, so for no arbitrage, we know that that 106 Aussie dollars needs to be converted, or the rate in which we lock in to convert it has to mean that we convert it to 103 US. To figure out what that exchange rate is, remember we're in the indirect system, so you divide both sides by 106, means 1 Aussie dollar will be locked in to convert to 97 US cents. That's the forward rate. Sorry, I don't know why those arrows are out of line. Okay, so that's your forward rate that you're going to lock in today. Remember, forward rates are a way to gauge market expectations. So we can say that the forward rate implied that the expected movement in the currency is a 3% depreciation. Right? We expect, based on the forward rate, the Aussie dollar to go down by 3% over the next year. If the Aussie dollar goes down by 3%, our return will be boosted up by 3%. It's not a coincidence that that 3% is exactly equal to our interest rate differential. Right? 6% local risk-free rate, less 3% US risk-free. That is a slight approximation. I'll come back to that in the end, but that's okay. Right? So what that means is that the amount by which we expect the currency to depreciate is equal to the interest rate differential. So when we break up the return from the change in currency, we can break it up to equal the return from the currency change that we expect and the return from the currency change that we don't expect if we're not hedged, right? Because if we're not hedged, we're going to be affected by both expected and unexpected changes in currencies. If we're hedged, we're only going to be affected by the expected change in currency because that's the rate we lock in to exchange. So when we go back to this world where we're an unhedged investor, that return from the change in currency can be broken up into the expected return from the expected change in currency plus the return from the unexpected change in currency, and the expected change in currency return equals the interest rate differential, or 3% in this example, and then you add on the currency surprise. Right? The return from the unexpected change in currency is CS, the return from the currency surprise. Now note, we've got risk-free in the local currency, less risk-free rate of the international currency. That is an approximation. The exact calculation that you're going to do in your Excel video work and then discuss in shoots is shown at the bottom. But we're going to use the approximation because we want all the different terms to cancel out. So when we go back to breaking down our returns, the return from the currency movement can be broken up between the return from the expected and unexpected currency movement. The return from the expected currency movement is the interest rate differential. The return from the unexpected currency movement is the currency surprise. We're not hedged, so we're exposed to both. You can then cancel out the international risk-free rates. That's why we're using approximation form, to say that the return on the unhedged world equity investment is equal to the local risk-free rate plus the international market risk premium plus the return from the unexpected currency change, which we call the currency surprise. If you're hedged, the only difference is that you are not going to be exposed to the currency surprise. There is no surprise for you because you've locked in what your exchange rate is going to be. And because of covered interest parity, we know that you've locked in a depreciation equal to the interest rate differential. So we're breaking it up in the same way. The return from a hedged investment can be broken up into the return from the international investment in the international currency plus the interest rate differential without the currency surprise because it's zero. The two international risk-free rates cancel, which means that return from a hedged overseas investment is the local risk-free rate plus the international market risk premium. So now we can see that the only difference is the decision of whether or not you want to be exposed to the currency surprise. What we're going to see later on is that, funnily enough, that currency surprise is actually a valuable diversifier, and it's why the unhedged investment is lower risk in Australia than the hedged. Because what we're going to see, and I will come back to this, is that when the international overseas return is up, the currency surprise is down, and vice versa. And those counteracting effects will actually smooth out returns. But we'll look at that later on. Okay, so now we know that the difference, the only difference between unhedged and hedged returns is the return on the currency surprise. What we're now going to do, though, is move into a bias that exists in currency markets, and that's called the forward rate bias. If a currency surprise is truly a surprise, what should its expected value be? 0. Because it's a surprise. You don't know what it's going to be. It might be up, it might be down. So it's like a random walk. I don't know what it's going to be. I can just look at where I am now. If it's a surprise, you can't predict its direction, which means the expected value of a currency surprise should be 0. But as I think you guys know where I'm going, it's not on average in the past. And that means that essentially it creates a bias because we should be able to predict that currency surprise term isn't going to be 0 over the long run. That's what we can see here. Now what we have here is the return of hedged less unhedged. Right? The previous graph was unhedged less hedged. I flipped it to hedged less unhedged because I want you to see the correlation with the Australian-US exchange rate. The other thing to note about this graph on the left, and specifically the line in the blue, is that this is now a total return index because I want to show how the money will accumulate over time. The actual series started in 81. I've actually moved it forward to 82 because I wanted to get the 2017 point in there. But back when I started the series in the previous year, it started at $1. Essentially imagine if you start with $1 and compound the relative returns, how much better off would you be over this whole 35-year period being unhedged versus being hedged? Because the series ends up above $1, it means that overall hedged has outperformed unhedged from a return perspective. And it actually has by quite a long way. Right? The difference in compound returns between hedged and unhedged is 1.2% per annum. That doesn't really seem like a currency surprise with an expected value of 0. Right? Because remember, the only difference in the return is the currency surprise. If it is a surprise, it should have a 0 value. It's hard to argue that when systematically, on average, although it's been volatile, hedged has outperformed over the long run. Whether we look at the past 30 years, whether we look at the past 10 years, hedged has outperformed. Which is why we call it a bias. Now, before I go into the definition of the forward rate bias, let me just show you again how closely the difference in performance between hedged and unhedged is tracked by the exchange rate, right? When the exchange rate's going up, the series is going up. When the exchange rate goes down, the return series goes down with it. Okay, so the forward rate bias, and this specifically refers to being a high interest rate country, which I'll come back to in a moment. If you are in a country with a higher interest rate compared to your overseas market, then the forward rate bias means that the amount that the currency, your currency, will depreciate in the spot market is less than the depreciation that you would lock in by the forward rate. Now, that's never going to make as good a sense as when you see it in an example, so let's look at that. Remember, this links into what we said before. We have an Australian investor. Remember, the exchange rate was at parity. The Australian risk-free rate was 6%. The US risk-free rate was 3%. And we said as a result, the forward rate, which is an example of the expected currency depreciation, was a 3% depreciation to a forward rate of 0.97. So if you invest in a US asset today, and it's going to give you $1 million 1 year from now, if you're hedged, you've locked in that 0.97 conversion rate, so your 1 million US will convert to 1.03 million Australian. If you're not hedged, you will convert at whatever that spot rate is at the time when you realise that investment of 1 million US dollars. What the forward rate bias says is that on average over time, the amount of the depreciation in the spot market for Australia has been less than the depreciation that you could lock in under a forward contract. So if you're locking in 0.97 under the forward, it's like saying on average, for example, you might only lock in a depreciation of 2% to 0.98 if you're not hedged and exposed to the spot market. And remember, you want depreciation, right? So what we're saying is in the spot market, the currency doesn't depreciate by as much, which isn't good, because your 1 million US would therefore only convert to 1.02 million Australian. So from a return perspective, if you are in a high interest rate country and you have a forward rate bias, on average you are better off hedging. I keep saying on average because it is volatile, but if you're a long-term investor, averages matter, right? Because if you have a 30-year series, it means that on average you will gain by being hedged from a return perspective. So the question becomes, lucky me teaching it right now, the question becomes, well, is Australia a high interest rate country? The answer is yes, it is a high interest rate country. It has always been a high interest rate country. Previously, there's only been 2 occasions where the US interest rate was above Australia, early 80s and late 90s, and you can see how brief they were. The reason that I'm in a very unique position teaching this course today is that we're now in the 3rd such occasion over the last few decades, in that I think most of you would probably be aware the Fed in the US has been raising interest rates quite a lot lately. And right now, at this exact moment, US interest rates are above Australia. They're actually above a lot of other countries where historically they've been below. I don't think that will persist. I think there is a very, very small chance that Australia won't raise interest rates above the US in the relatively near future. So I do not want to teach this course calling Australia a low interest rate country, because it's not. It's not going to stay that way. On average, it's a high interest rate country. You've seen how it's returned in the past. It will return in the future. But just be aware that in this exact moment in time, Australian interest rates are below the US. The next time I teach this course, I would bet a lot of money that I won't need to have that caveat in there. Australian interest rates would be back up. And remember, we are investing for the long run in super, which means we don't care whether right now Australian interest rates are low. If we're maintaining an asset allocation through time, what we care about is the average effect. So it is still valid to think of Australia as a high interest rate country, even though right now it has been reversed. The RBA needs to catch up. Okay, so the next question is, all right, we said there's an advantage from a return perspective to being hedged. What about risk? And it's both of these factors together that help us to decide how much to hedge and how much to leave unhedged. What you're going to learn how to calculate in your in your Excel work from the online videos, and you're going to discuss it in your tutes. And if I give you the information, you could use this formula in the exam, and I've asked you to use this formula in the exam in the past, is the optimal hedge ratio. Now, this is a mean variance hedge ratio. It is quite sensitive, as you'll see in your Excel work. But the reason I love the formula is not that I think that you should decide your hedge ratio based on it, because there's only a few circumstances where that would work. I love this formula because it fully summarises the different things you need to consider when deciding how much to be hedged and not hedged. So after we learn the formula, we're going to learn how to apply the principles of the formula in practice, exactly like we did with modern portfolio theory. So you've got 2 different parts of this. Essentially, to figure out the optimal hedge ratio, which is the proportion that should be hedged of your world equity investment, you've got 1 minus a ratio of 1 divided by the weight of foreign assets in the portfolio, and then this big bracket, which is a return term less a risk term, like any good mean variance equation, right? The more return it adds to the term in the brackets, the more risk it subtracts from the term within the brackets. Now, the return term is essentially the expected return from the currency surprise per unit of risk, scaled by a level of risk tolerance, which makes sense. Because the more tolerant you are to risk, or more importantly, the higher the expected return on the currency surprise, the more you are in favour of not hedging. Because remember, it's when you're unhedged that you benefit from the return of the currency surprise, right? The higher that return is, the more you should be unhedged from a return perspective to take advantage of it. Remember, there's a negative here. So the higher this return term is, it will be 1 minus a greater number, which reduces the hedge ratio. Now, in Australia, though, the average return to the currency surprise has been negative because of the forward rate bias. That puts you in favour of hedging, because if this is negative, you've got a double negative when you expand the brackets, pushing up the optimal hedge ratio. And you're going to see that in Excel video 8 if you haven't done it already, right? Over the past 30 years, the average return from the currency surprise has been negative 0.9. You saw over the past 35 years, from this previous graph, the average return from the currency surprise was about negative 1.2. Over the last 10 years, it's been about negative 0.6 per annum. So the return due to the forward rate bias, the negative return from being unhedged, or the return from the currency surprise, it's negative, but it has been moving towards zero. But even over the last 10 years, from a return perspective, you are better off hedged, because this currency surprise term, this bit is negative, reducing the return to being unhedged. You then subtract your risk term. Now, your risk term has a correlation, which is what's important, I'll come back to that, times by the standard deviation of a zero exposure portfolio, that's 100% hedged, divided by the standard deviation of the return on the currency surprise. You're going to do this in the tutes, remember. But what really matters is this correlation term. This is the correlation between the return on the currency surprise and the return on your overseas portfolio had you fully hedged your currency risk. Now, remember how I said that there's actually a diversification benefit to being unhedged? That's what comes through in Australia. It's different in other countries. But in Australia, that is the case because of this risk term here. What tends to happen is when world equity markets go down, the Aussie dollar drops with it, and if the Aussie dollar is depreciating, what's that doing to your return? Bring it up. So when you're, essentially what I'm saying is, and it's better to see it in the equation, when you're overseas, I'll do it in market risk premium terms, when the market risk premium or the additional return to global equities above the risk-free rate, when world equity return in the overseas currency is dropping, you're getting a positive or a rising return on this currency surprise, and the two effects are cancelling. When the return on your overseas investments in the overseas currency is rising, the Aussie dollar rises with it, which brings down the return from your currency surprise. So when this term is going up, this term is going down. The result is you've got two counteractive effects that are smoothing out your returns. Whereas if you are not exposed to the currency surprise, all you have is when world equity returns are going up, you're going up. When they're going down, you're going down. But you don't have the counteracting effect causing any smoothing. So because there is a positive correlation between the Aussie dollar and world equity markets, there is a negative correlation between the return on the currency surprise and world equity markets, which from a risk perspective puts you in favour of not hedging, right? Because the two effects are counterbalancing, smoothing the returns. You're going to see that in Excel video 8, and here the effect is actually becoming stronger through time. Over the past 30 years, this correlation term has been negative 0.2. Over the past 10 years, it's been negative 0.6. the diversification benefit of not hedging is becoming stronger through time. So from a risk perspective, there is more argument to being unhedged, particularly in the past 10 years compared to the past 30. Even over the past 30, you're better off from a risk perspective being unhedged, but the effect is strengthening. A couple of other things about the hedge ratio. One, essentially, it just means that the way it looks at currency is, do you want to add another asset class to your currency hedge portfolio? Right, so essentially the decision of whether or not to hedge is a decision of whether or not you want to be exposed to the currency surprise. The optimal hedge ratios do sum across asset classes. You don't need to know that in this course because you're only ever going to calculate it within equities, but it is a nice feature of the measure. But the two massive issues with the measure is, one, it assumes a normal distribution, and currencies are usually not normally distributed. And the second is, like anything that's mean variance, it's really sensitive to inputs. So what you expect the currency surprise to be is subject to a lot of estimation error because it's volatile through time. Small tweaks to what you expect is going to result in very different hedge ratios, which means that actually using this ratio in practice is quite difficult. Now, in the Excel video, you're going to calculate the optimal hedge ratio assuming a zero expected currency surprise, the historical average, and a mean reversion. And if you haven't done it already, just to show you how sensitive it is, these are three different optimal hedge ratios where all you're doing is changing what you expect the currency surprise to be. You're going from having a negative hedge ratio to above 100% to about 50%. So what you assume in terms of the currency surprise is going to have a big impact on the hedge ratio that results. So given that, in practice, unless you are quite certain about your estimates, it makes actually a lot of sense to use the formula as the basis for your analysis, but not use it to actually determine your hedge ratio, right? Just like we said with bottom portfolio theory. So if we're going to take lessons from that hedge ratio formula, how would we set the hedge ratio in practice? Well, you'd first consider your expected returns. If you expect the forward rate bias to continue and you're in a high interest rate country, the forward rate bias means that you would have a negative expected return from the currency surprise, which favours hedging. Of course, if you're in a low interest rate country and you expect it to stay low interest rate, which we don't expect, well, I don't expect in Australia, none of the analysts expect in Australia, but if you were in a long-term low interest rate country, then that would obviously be reversed. The forward rate bias would put you in favour of not hedging. But you might not expect the forward rate bias to continue. So what is your currency outlook? Perhaps you expect mean reversion of the currency to PPP, which you do an Excel video for this week. What are your views on market exchange rates? If you do want to hedge, what's the cost involved? Right? You have to roll over contracts. You need to rebalance. If you outsource to a currency manager, you have fees, although luckily they're not big, 5-10 basis points. So these are the type of things you'll consider when you look at whether you hedge from a return perspective. Then you bring in the risk considerations. Specifically, first of all, you say, well, what is the correlation of my currency with a zero exposure portfolio? If you're in Australia, that's a negative correlation between the return on the currency surprise and the return on the world assets. So from a risk perspective, it puts you in favour of not hedging. Right? So this is all, if you have a sort of, let's say that you start with a hedge ratio of the peer group. It's all about arguments that will move you one way or the other at the margin. I say at the margin because you need to consider benchmark relative risk, right? If you're evaluated based on your peer group to have a very different hedge ratio, we saw how much that will impact your tracking error. So if you are benchmark relative in your risk, you might not want to move too far away from your peer group on that hedge ratio. You'll consider regret. Now, psychologically, from a regret perspective, the safest thing to do would be to hedge half your currency exposure and leave the other half unhedged, because then, no matter what happens, you've won on half, lost on the other half, but at least it's not, you're not going to sit there going, oh, damn, why didn't I do the reverse of what I did? Okay, so there's a few arguments to say you hedge half, and at least that way you'll gain in one part of your portfolio. But with hedging, you need to consider cash flow implications, because if you hedge with futures, right, you're going to have marking to market. So let's say you're hedged and the Aussie dollar goes down. That means that your world equity portfolio goes up, but unless you are selling that world equity portfolio, you're not getting the cash. It's a paper gain until you sell. But your world equity portfolio has gone up, you've lost in your futures position, and marking to market means you need to settle the futures loss in cash. Now, depending on your portfolio, you may or may not have the liquidity to be able to do that. So if you want to have a hedge position, that increases your liquidity needs because you're going to have marking to market. And if you do decide to hedge, there's a few other things you need to consider. The first is what we call slippage, in that you can't hedge against what you don't understand. You need to know your currency risk to hedge against it. So here are some examples. Let's say that you invest in a company that has operations all around the world. Even if they're listed and based in Australia, they will have currency exposure because their expenses or their revenues might be derived from overseas. So do you hedge that currency exposure, or is the company already hedging it? And if the company is already hedging it, so you don't need to, are they likely to continue hedging it, or will they change their hedging policy? You need to keep on top of it. But at least you can monitor it. It's complicated, but you can monitor it. Let's say you're invested in a global hedge fund. They might invest all around the world. They might not tell you the countries they're investing, which means you don't know what currency risk to hedge. And even if they tell you the countries, they might not tell you their hedge policies. So you might know what currencies you might need to hedge, but not know whether you actually need to hedge it. And if you hedge what they've already hedged, you've undone your hedge and wasted a lot of money. So you need to understand to hedge against a risk. The cost of hedging is also a concern, but as I said, it's minor if you do it properly, 5 to 10 basis points per annum. Looking at the different asset classes, equities tends to be where you focus on the hedge ratio, right? Fixed income, you tend to hedge, and in other asset classes, it's a mix, but we don't look at it in the course. For this course, when it comes to the hedging decision, only focus on your world equity investment. And like I said, if you want to hedge, but you don't want to hedge yourself, you don't want to decide the hedge ratio yourself, you can outsource it to a currency overlay manager, and they will work on that for you, given your objectives and constraints that you feed to them. They're not that expensive. They have been used more and more in the industry, right? So there was a survey in 2017 by NAB, and it showed that from 2015 to 2017, that's just 2 years, the use of overlay managers went up from 10% to 35%. So that's a big growth in the use of overlay managers. But that said, superannuation funds also claimed that they were going to reduce their reliance on overlay managers in the future. We'll see. And what I wanted to finish with is just a reminder that everything I've taught you in terms of what's higher return and what's higher risk comes from the perspective of an Australian investor. Right? The Australian dollar investors, the Australian dollar tends to be the higher returning asset. In other words, if you're an Australian investor, you are better off hedging from a return perspective because of the forward rate bias. The Aussie dollar is not depreciating in the spot market as much as what's locked in by the forward rate. From an Australian dollar perspective, hedging also tends to be higher risk. And that's because of the negative correlation between the return on the currency surprise and the return on overseas asset classes. But if you were in a low interest rate country, the forward rate bias would favour not hedging. And if you were in a country where there was a positive correlation between the return on the currency surprise and the return in overseas assets, that would put you in favour of hedging from a risk perspective. Right? So if you reverse the directions, whether it's above or below zero, you reverse the implications. So you've always got to be specific about what country you're talking about. So an Australian dollar investor would see hedging as higher risk and higher return, which is why I said it's so different to our intuition normally with hedging. You think hedging removes risk, but in Australia, hedging increases risk when you're looking at the currency hedging decision. Remaining unhedged will reduce portfolio risk and return. We're not talking about tracking error risk, remember. The way to minimise tracking error risk would just be to be identical in your hedge ratio to your peer group. We're talking about overall portfolio volatility. And when it comes to deciding what to do, it might be a matter of your preferences and your beliefs. Right? We've had a forward rate bias up until now. You might believe it would disappear. If it disappears, that takes away the benefit to hedging from a return perspective in Australia. You might think that the negative correlation that is favouring not hedging from a risk perspective will shrink away, which takes away the advantage to being unhedged from a risk perspective. You might think, I don't recommend thinking this, but you might think that from now on Australia would be a low interest rate country, which would change your perspective in terms of the forward rate bias. If you're a low interest rate country and the forward rate bias persists, from a return perspective you're better off not hedging because you have less appreciation in the spot market than what you would lock in by the forward. And in terms of preferences, I mean, at the end of the day, if you think that all of this is more complicated than your interest or skill set or area in the real world, your decision might be, I don't want to decide my hedge ratio, I'm going to outsource it. In which case, you've got your currency overlay managers. You can't bring them into the exam, so you need to understand the concepts. But remember, in the real world, this is a decision that can be outsourced if you don't want to make it yourself. All right, any questions? Excellent, thanks guys. I will see you in the workshop tomorrow. It is the last assignment workshop. So if you have any questions, come to the workshop. I've got my consultation afterwards, and I hope it's going well. Oh my God, I finished early. That never happens.